Thank you for joining iMeet. When you hear the tone, you will be the 18th person to join the meeting. This meeting is now being recorded.
Hey everybody, good afternoon. This is David Blake with Tuesday Tech Talk. And it's going to be kind of a shorter meeting today. We're going to review last week's market action, and then we're going to look at some different things that are going on here over the last 2 weeks that I think it's real important that I pointed out to you if you haven't been following it yourself. And that is whether we're just in a market pause or whether we are starting in the beginning of a correction or whatever. And we'll look at some of the different charts and indices and kind of take a look at whether we see some negative divergence or whether we see some underlying strength. And I think some of you may be a little bit surprised. Okay, first of all, let's look at that last week's market letter. The Dow Jones, S&P 500, NASDAQ were all lower, less than 0.5%. The S&P 500 and NASDAQ broke a 6-week winning streak, and the Russell 2000, though, was actually down for a third straight week. We had the Dow Jones Transportation Index and the Russell 2000 trade below their 50-day moving average. They're way below that again today. Our momentum index fell to a -4. That's a proprietary index which measures how the other indexes are doing versus the Dow Jones. And that -4 means the Dow has been outperforming those other indexes, which can be kind of a negative. You'd rather see some of the small caps and transports and stuff outperforming. Breadth was negative last week. We had the Dow Jones losing almost 4,000 units on the AD line. Basically, it gave up all the unit advance from February when the Dow was at trading at about 19.9. Also for the NYSE, we had more new 52-week lows and new highs on 4 of the 5 sessions. That was the first time that has happened since the first week of November. A few other things that I'm looking at, only 49% of stocks as of yesterday are now trading above the 50-day moving average. So you have half of the stocks on the big board trading below that, which is definitely a red flag. But it's more important when they trade below the 200-day. And looking at that, we have 65.8% of the stocks in the NYSE are above the 200-day. Moving average. That means right now we have 35% of the stocks on that NYSE are already trading below that 200-day moving average. That means that almost a third of the stocks on the New York Stock Exchange are close to being in a bear market. That's not the signs of strength we have there. Okay, the sentiment is still neutral on our indicators, looking at a whole bunch of different ones, but the most concerning to me is that the percentage of bullish investment advisors, which is a contrarian indicator, which measures what the pros are actually thinking. When that gets too high, above 55%, it's a red flag. When it gets above 60, it's actually they call that the danger zone. And what that means is that when it gets up there up above 60 plus, you're going to see a decent pullback in the market. We were in the danger zone 6 weeks in a row here. Last week it fell back to about 57 and change. Also last week, with the market only being down 0.5% for the Dow, I think the NASDAQ was only down 0.1%. Technology was really the only sector that was positive. Healthcare was flat with a little bit of an upside, a little bit positive, but just barely. Every other sector was in the red. Real estate investment trusts and energy were the worst performers. Materials were also bad. Crude oil prices hurt the energy sector. We had that crude oil prices were down almost 10% last week alone. So big buildup in inventory. That's kind of a red flag. If on a really strong economy or worldwide economy, you might see some of that. See that start to bottom out. But despite all that negative I just read off, like I said, the major averages were off less than 0.5%. So what I want to point out about that and why all this negative stuff can be happening and why the markets don't seem to be going down. What is happening in this market is we're seeing a lot of money going into the ETFs, especially the SPY, the Diamonds, and the QQQ. It's called this is the passive index buying that you've been hearing everybody talk about, that you'll do better with doing this than what you would with an active management. So what's going on is by the inflows going into those ETFs, it's been masking the underlying weakness in the broader market. So what I want you to get out of this, if nothing else today, is we are already in the process of beginning of what could be a fairly good pullback. You know, I've never really seen anything like this where every week out of as far as the domestic equity funds, which are more than mutual funds, you constantly have $1 or $2 billion going out, but that money's just going out of those mutual funds and into where you have, you know, maybe a couple hundred stocks to these ETFs. Barron's this week had an article about this also, and if you really follow the market, especially towards the end of the day, every single day we could be down 50, 60, 70 points. And at the very last 30 minutes, you'll see this market come back up. We record probably anywhere from 25 to 30% of total volume on the day, and you'll see this, the market head on up where we end up only down maybe 20 points. What's going on there is these ETFs have to rebalance their position sizes in these different stocks. So they have to go in and they will buy that. They have to buy the stocks in these ETFs. And if you'll look, it's funny because last week, the first couple of days of the week, we were down 25, 40, 50 points, and you had about 700 or 800 stocks that were advancing versus 2,200 stocks that were actually lower. In addition to that, you had the declining volume was sometimes hitting 65% of the total volume on that day. However, what was being bought was concentrated in those ETFs and concentrated in those indexes. So it's very important to know that the underlying strength is not going on in this market. In fact, on this chart over here, you can see the money flow index coming down here. While this market's up here making new highs with the Dow, you can see the money flow index coming down here. I still don't see a lot of divergence in the Dow and the S&P 500, but there are. On this chart here, you can see this thing. We're still on the Dow. We're about 8% above the 200-day moving average, and momentum has slowed as we're kind of working our way a little bit lower over here. I think we're down about 5 out of 8 days or something like that. On the 30-day stochastic, you're just now starting to get not overbought, so that's something to keep in mind. We still have a lot further to go. I think 14-day RSI is still positive at 58, but a dip below 50 would be another red flag. Okay, here's some of the deterioration I'm talking about. Here's the advanced decline line on the NYSE. You know, this big move like this wiped out almost all of the February gains. We're also today, even though the market's well, now we're starting to go a little bit lower. Just a little bit ago here, we were down about 20 points, and we had 850 stocks advancing versus 2,100 going lower. So this is going to drop another 200 points here. Let me get my pointer. Okay, so we're going to lose another 200 points. It's going to take 2,000 units or 1,000 units or so. It's going to take us down right to about here. Probably take out this low today on the NYSE. Again, that's just showing you right at this stage we have more stocks going down than going up. Now, for the first time since last November, over here, we have 3 of the 4 days last week, or 4 of the 5 days last week, we had more stocks making new 52-week lows than new highs. Today you have the NASDAQ for the first time having more new 52-week lows than new highs. We're at 47 and 58 right now, but that should be going down. In fact, as of just a few minutes ago, with the market being down about 50, 60 points, 75% of the volume on the NYSE was declining volume today, and 73% of the volume is declining volume on the NASDAQ. That's improved a little bit in here, but we're starting to roll over again. And these are things you can find these charts on the home page of Market Edge, where it says Market at a Glance. If you click on that, this will be updated every day, and it'll show you some of the inner workings. Again, like I say, when you see something like this, you need to be a little bit cautious. Okay, here's the S&P 500. Oh, no, this is the diamond. I'm sorry. This is the DIA. Here's an accumulation distribution line on this thing. This thing's working its way up as this thing's going up. That means that's the buying going into these 30 stocks on the diamonds. The rest of the NYSE, not so much. But you are having a little bit of slowing on momentum on this. Also, you have a sell on the 12-day, the shorter term MACD. But the pivot point on the diamonds is 204.51. I believe on the regular index, the pivot point is 20,500 on that one. So when I talk about the pivot point, that's where traders, especially active traders, will start considering going short on the market. So again, right now we're at 20,819. This thing is still going on 300 points, and most traders aren't going to be thinking about getting short quite yet. As far as the 50-day on the Dow, it's coming in here right around 20,305. So you have a long ways to go yet before these things hit major support areas. So I'm not talking about a correction where we're going down, 15, 20%. I just want to let you know that the odds favor that we're going to probably go down, at least test this and maybe a little bit lower. Okay. Okay, now we're going to look at the S&P 500. There's a few things on here that I follow and track my daily workings. Okay, the pivot point on the S&P 500 is right over here at 2335. We're at 2360 right now, so another 30 points. That's about another 220 points we can go down to the Dow before we're going to test the pivot point on the S&P 500. Okay, the 50-day on this one is 2314. But going into today, from here to here, you were still last week over here. I think you were 9% higher away from the 200-point moving average on the S&P 500. That's something you don't see very rare. We talk about testing, testing from here to here with our fingers. That'll give you a point where you'll see consistency of how far this thing gets away from the 200-day moving average. Okay, right now we're just coming back down. It's going to be back down here almost to the pivot point before we get down to a normal, 5 or 6% away from this 200-point moving average. That's another red flag going on with that. Now another thing over here when we were hitting this, let's see. Okay, when we were hitting this point, we had 32.5% of the stocks were within 1% of a new high when we made this when stock was up here over here right around the 1st of March. Okay, between there and here, okay, now we only have 16.5% of the stocks that we follow are within 1% of making a new high. That's quite a drop. It's almost half the number that were up there just a matter of a week or two ago. Also on the other side, as far as new lows, in mid-February, we had about 7.5% of the S&P 500 stocks were within 1% of their 52-week low. And we've kept moving up here, and now we have it as of Friday. We had about 12.5% of the stocks in the S&P 500 were within 1% of their new 52-week low. Another red flag on that. So, another thing that I can follow that you may be familiar with, and this may be something new that you can look at on the list status on the home page. Second opinion in Market Edge is a trend following model. The CTI and the market posture is a forecasting model. But when you go into the list status and you can see how many stocks are long, how many are avoid. Okay, just on January 24th. Okay, that's back. Okay, right over in here. We had 2,438 stocks were rated long. And that same day, we only had 308 stocks that were rated avoid. So just about everything in the market was in an uptrend. Okay, as of today, when I was redoing the numbers, that number in the long has dropped down to 1,783. So you've had about 700 stocks that have rolled over in that time period. And we went from 308 up to 1,139 that were rated avoid. So that's 800 stocks that are starting to trend lower just by following that indicator. And that's something that if you haven't looked at that before, besides you can tell, when in the list status, if we get something where 80 or 85, 90% of the stocks are all trending higher, you can take that pretty much as a overbought market. When you get down to 308, again, that's a very overbought market. So that's a few things that I want you to take a look at look at some of the different indicators you can find on the Market Edge page. Okay, here's the NASDAQ. Again, we're just going sideways over here. However, last week we lost about 2,000 units on the AD line. It's also in the process of giving up all the gains that it made on this run up. Just going sideways here, you've lost all the units on the AD line. Now, another thing I want to bring up, when you look at charts on the AD lines, and you can also draw in trend lines on those kind of charts also. Just like on the S&P 500, if you look at a chart that says when you get down to about 50% of the stocks are trading below the 200-day moving average, that a lot of times that'll start to show support. It'll bounce off that 50% things, and that's just as good of a support indicator as some of these trend lines that you actually draw in. But anyway, you're starting to see some momentum slowing down again on the NASDAQ. Here's the money flow going into this is the Chaikin money flow. This also is showing you that a little bit of a pullback, but it's still pretty strong, as this QQQ is up here almost less than 2/3% away from making an all-time high. So that's a little something that you also want to keep looking at on that thing. Now we look over here at the NASDAQ advanced decline line. Remember last week we were talking about over here. I said if you see this thing pull down and test this area, and it breaks below it, that's a big red flag for you. Today you're gonna pick up another 1,400 units to the downside. It's going to bring you, you're breaking this today on this thing. Right now we have 667 stocks on the NASDAQ that are up, 2,042 that are down. That's not good. In fact, on the NYSE we're up now to almost 1.1 billion on the declining volume versus 296 million advancing, and the market's only down just over 50 points. That's hard to reason with that. Okay, over here you'll see again the new 52-week highs and lows. Yesterday this came down, and these things finally crossed for the first time, or today they crossed for the first time. So that's another red flag that we'll see on that. Okay, one of the other things we look at, which we aren't seeing a lot of volume going into, and that's the Russell 2000. That ETF is the IWM. You can see this thing here is starting to roll over. A little trend over here. You got some support down here. We've already crossed below the pivot point. We've crossed below the 50-day. Today we're at 1361, which is we're still about 30 points above the 100-day moving average, but there's negative divergence going on here with the histogram MACD. Here's a 14-day RSI. This thing's trying to punch out new highs. This thing just keeps getting weaker and weaker. Again, even on as far as how high it goes on the stochastic, it gets weaker and weaker. It's almost textbook. And if you start to see these going on in the Dow Jones, the NASDAQ, and the S&P 500, then you're going to know that this market, the Trump bump or whatever you want to call it, is probably over for time being. Then you want to prepare yourself for even more selling. But again, this is something you want to. It's also bothering because with the pro-growth policies that we've they talk about, the small caps should actually be one of the beneficiaries of Trump's pro-business policies, but it doesn't appear that that's happening right now. I don't think it's run out of gas. The multinationals, which make up a lot of the Dow and all, they actually should be the ones that are having a little bit of trouble. They're going to face more headwinds with a stronger U.S. dollar. That's going to curtail their earnings a little bit overseas. And also, when you start talking about some of these trade barriers, that can also kind of hinder some of the revenue growth for the multinationals. So this is telling you that what should be leading higher here is not anymore. It's rolling over. That's another red flag that you want to consider. And here's another one that we talk about a lot. Here's the Dow Jones Transportation Index. We're down 1.25% today. So we're down here on 9135. You've broken down to this area. You've broken down to low support. The 100-day moving average is at about 1920. So you're about 100 points or so away from this. But again, here's some negative divergence on this. You know, this thing was trying to punch out new highs over here, and it did just almost about 2 weeks ago. But that wasn't confirmed by the different indicators down here. This is all negative divergence again. And again, this is what we want to look at in the Dow and the S&P 500 and NASDAQ to see when this starts to happen. But again, you're not seeing the ETF passive index funds. They're not buying the Russell, the small caps, and they're not buying the Dow Jones Transportation in average. So these you're not seeing that last 30-minute bounce come in where a third of the volume comes in and gets rebalanced with these ETFs. So this is actually a little bit more of an indication of what the broader market is probably doing. We've talked several times about this 9,000 level, which is kind of where we found support back here. We're down 113 points today. Another day just like this, and we're going to be down here testing this 9,000 level. And a break below that, I think, would be very, very a broader market that would take out the 100-day moving average and probably knock this thing down even more. So in some of the past webinars, we've talked about a different way to use the 14-day RSI, and that is when you see in a bull market, the RSI is going to usually stay above 40. It'll trade between 40 and 80. In a bearish market, it's going to trade between probably 15 to 20 up to about 65, maybe 60 where it tops out. Okay, we just broke below 40 this morning on the Dow Jones Transportation. If that would stay below 40, say 4 or 5 days in a row, that's going to tell you that perhaps this is going to start to enter a bear market on the transports, and that would be I think we got from 9,500 down to about to 9,000. Maybe we can talk about that a little bit later. But again, lots more negative divergence that you need to be aware of. Now on the other side, here's the Philadelphia Semiconductor Index. Semiconductors are still one of the strongest industries. Made a new high on Friday, but which you don't see the ETF rebalancing going on in the semiconductor index. You do in the NASDAQ. So what's going on? You're having a little bit of negative divergence going on here. There's a 14-day coming down. Just a little bit of it. This isn't big negative divergence, but it's enough to know that we're starting to roll over here. Today we're down 0.75% at 992. This trend line comes in around 970. So that's kind of where you want to see if the semis come down and break that trend line. That would be a red flag for that. So keep an eye on that, and also keep an eye if we do go sideways. What's going to, whether this can take out these old highs and whether these can reverse themselves. But I don't think that's going to be likely. Okay, one sector I do want to get into, 2 reasons. Here's the energy sector, and this is corrected probably, I want to say 12.5% or more over the last several weeks. This topped out actually back in December, I think, and we're down again today. XLE is, oil's trading down here at, let me see, we're at 47.40, down another 2% today. Very bad for some of the oil stocks. I don't think it's time to get into that sector yet. XLE is down 1.36% as we speak. That would get it down to 69. So we're right over in here at this support 2 on the pivots where we were earlier this morning. Again, I don't see much any bottoming situations yet. We are still at let's see, we're down here around 32 on this. So as you can see, when you're starting to get into a bear market, this thing is going to have a hard time getting up over 50, but especially on this maybe on an oversold bounce, you'll see this 14-day RSI come up to about 60, 61, 62, and that's as far as it's going to go on these bounces. Okay, here's a nice little bounce there. You get up to 50. Here's another little bounce on the XLE over here. You got up to 50. So if we come down here again and try another bounce, watch to see if it gets up to 60. You could probably short that thing again. The oil stocks, I think perhaps you can get some of these, especially the refiners, and look at some areas if this thing comes down and tests the lows from down here in September around this area. You're very oversold. This is the 30-day, which means it's weak. When it's below 20, it's weak, and it's staying weak. Not until you see this thing get above 20 on the 30 days, 3 stochastic, do you want to start thinking about going in to pick up some bargains. I think you'll see this work its way lower. You'll get some other bounces like you have in this channel, where you can get a bounce back up here to this area. But have a line, a list of those, because if the market does kind of come back where we correct about 5, 6, 7%, and then we start to see the market go higher again, that would be the time when you want to step into some of the oil stocks, because they are oversold, but I think they've got a little bit further to go on the downside. Okay, I had a couple questions before I wrap this up and open it up for some questions. Then we'll wrap it up. That was about the CTI and the market posture. So far, what we've looked at negative divergence in the indexes, fewer stocks making new highs, more making new lows, the deterioration in the AD line, and we talked a little bit about all the money going to the passive ETFs. One of my problems I wanted to bring up is that they don't talk a lot about with these passive ETF investing, is a lot of that money is what the professionals call mom and pops going into those, the QQQ and the SPY and stuff. And my problem with that is one of the things is when individuals, the retail client comes out of the market, when they start to sell, they don't look to go back into it in 3, 4, 5 days. If you're in the SPY and all of a sudden when you got a 7 or 8% correction and you're down probably maybe 12% or 13%, and you come out of it, you decide that's your threshold pain, you come out of it, you're not looking to go back in there in 4 or 5 days. Most of the retail clients are going to go to the sidelines. They're a little bit scared. Is this going to be another 2008? What's going to happen? They're going to go on the sidelines. Now, when there's more money that's going into some of the other funds, and you have the more active professional fund managers, they're looking. They usually have they're lightening up. They have some more cash to go into, and they're going to put money to work at some of the different support areas. They'll look at the 100-day moving average. They'll look at support from maybe back in here. They're going, okay, I want to buy this thing. Put some money, maybe a third to work over here. I'll put another quarter over here. I'll buy some more if we get down to this area right in here. So they're looking to get back into the market versus with a retail client, when his pain threshold has been hit, he's going off. He may be out for another 3 to 6 months. So that's the money that won't be going into the market to help support it. So I do have a big problem with that, and I think that you're going to, if we start to roll over, the money going into the ETFs has probably made the market go swing too far to the upside. I think it'll also help it to swing too far to the downside when they start to sell. Some other problems that are going on, also in the past, we had the central banks were coming in here where if you started to see a pullback like this in the broader market, you could have the economy wasn't that strong. The central banks were very accommodative, and they were actually would talk about we need to do some more quantitative easing, which was helping also to support a lot of the gains in this market. You're not going to have that going forward either. They're in a process where they're trying to raise rates so they can have some more ammunition for the next slowdown in the economy. And last thing that I want to talk about on any of these pullbacks is margin debt. Margin debt itself doesn't cause the market to go down, but when the market starts to roll over and investors get margin calls, and we are currently at another record level on margin debt. We're getting back where we were in 2000. When they get margin calls on this debt, that puts additional downward pressure on the market because these guys have to sell the stock to cover. So a lot of that will be in hedge funds and all, but just the fact that we're punching all-time highs here on margin is another red flag, because if something would roll over quickly, that's going to put more downward pressure. Okay, last thing here before we get to a couple questions, I see them coming up, is the CTI. Right now I'm neutral. And one of the hardest things on working with these cycles, and the longest one is a 4-year cycle, is when one ends, especially the big one ends, and a new one starts. And the reason being because during a regular 4-year cycle, I constantly go back and forth because it's a guesswork as far as where you see these cycles begin and end. I may go to a sell, and then the market actually bottoms 2 weeks, or we go to a buy, and the market actually bottoms a week or two later. Not a big deal. We just adjust the down point for the new bullish cycle, and that cycle we move it out 2 weeks. With the E cycle, as far as what I think has happened, we saw it should have been reset back the first week of November. I thought we would probably go a little longer, and historically, once the new president comes in, you do see a pullback while everybody sits back and waits to see what the policies were. And a lot of cycles would have thought we would probably bottom sometime in February, and we didn't get that. Now, the problem with that, and I don't have any problem going back, resetting the cycle back to November 1st. That would have kept us bullish through all this period right now. Cycle A was bottoming here, and cycle B also were bottoming here over this period recently. And historically, with those two bottoms, the market should have been weak over the last week or two anyway, including this week. But what I have to check this week is that the Dow Jones stays above last week's previous low, which was, I believe, 20,777. We got today to 20,800, I believe, something around that area. So we're within. If we take that low out, I'm going to stay neutral again. The reason being, if we start taking out those lows, then there's still a possibility that the 4-year cycle could end later on in the month of March. So that's still within the time realm of the different cycles. So we'll have to see that. If we don't make a new low this week of 20,777, there's a possibility that we could then go to a buy on the market, and then perhaps this negative divergence we see, that this may be about it, and we can work our way lower. And what we've had already is a very small correction of if you take out the top stocks, we've probably already had a 5 or 6% correction with the broader market, and not these three big indices. So let's kind of watch what happens this week. Again, we get the FOMC meeting concludes on Wednesday. Keep in mind that 20,777. If the Dow Jones trades below that, we'll extend the neutral market posture. I'm not telling you that I think you should go out and sell everything. When you have this many red flags, if I'm on margin, I would certainly recommend lightening up on margin. If you have stocks that are performing well, that are in the spot in the S&P 500 or some of these other QQQs, you wait until they start to hit your stop points, that type of thing. But I wouldn't be putting new money to work in those indexes, especially the SPY and the QQQ. But I would start to maybe have some lists in my technology, healthcare. I still like consumer staples, selective consumer discretionary. Some of those sectors have had a nice pullback, and in fact, next week we can talk about what sectors we want to go into if this, in fact, these cycles bottom out, and this is the end of the market's a little bit of a pullback or pause or whatever you want to call it. I've got a couple questions on here real quick. Let's see. How do you define the pivot point, and where can you find out a market edge? Don, it's too late for me to get into that right now, but it's the pivot points, R1, R2, and S1 and S2 are not on the Market Edge site right now. They're going to be in the new release, and these are what floor traders use. They're calculated by intraday highs and lows, and what they do is you subtract for the next resistance point, you take the intraday high, subtract the intraday low, find out how much is into that, and you add it to the close from the previous day. I will go into a whole session on that because it's something that you can calculate yourself and you can find other places. But along with the sectors next week, we'll talk about how to calculate your pivot points and support and resistance, because that's something that is still used every day on the floor for the floor traders. Linda wants to know about whether or not to buy an entry point for LVS and MIC. Okay, I'm going to go ahead and share the screen here for the charts. If you'll just give me a minute. Okay, let's try some couple of these.
David?
Okay, LVS. Okay, Las Vegas Sands. I do like the casinos. I think they've been doing well. This chart looks good. You've got this resistance up here at the 100-day moving average around 55.66. You tried to break through that this morning and didn't do it. But everything looks good in the chart. You're going to take out this area in here. If you can break above this area right in here, that's even stronger. Wynn Resorts was another one that looks good in here. WYNN. The casinos have looked fairly strong as far as bouncing back in here. So I don't have any problem with this thing at all. I'm not sure what the second opinion is on it, but let me see if I can get that. LVS. Okay, I don't have access on it right now. Let's take a look at MIC. This is Macquarie Infrastructure Company Trust. Okay, I will say one thing. These infrastructures had a heck of a run. Not sure what happened here. Not knowing anything about this stock. You can see in here you've got you're fighting a downward trend line. You're kind of coming into a triangle. If you have this chart on your smart charts, go ahead and draw in your triangle pattern here. And then what you want to watch is and also as you're trying to go sideways here, you got a pretty good drop off in volume. I would suspect that this thing is struggling with this 200-day moving average. I think this stock is more likely going to come down here and break below this triangle pattern than above it. Maybe you come down here as the 72 and change and see if you can get double bottom at that point. Because the RSI is still, with all this break, you're up here around 50. If that was up here around 65 or something, I would probably say maybe you're going to get something to the upside. But I'm leaning that this is probably going to go lower and break to the downside rather than the upside. And let me see what any more questions on here. Okay, I've kind of gone too long again. We've got about 40 minutes in here. I appreciate you taking time out of your day to join me on this. I hope you got something out of it. Main thing that I want you to get out of that is why, despite the fact that you see this market going down 0.5%, that buying in these ETFs is really masking what's going on underneath this thing. Again, today you're off just over 0.25%, and you have 2,200 stocks declining against 700 advancing, 3-to-1 almost on the declining versus advancing. And as far as declining volume on the NYSE, right now you're at 1.2 billion versus 289 million. That's not the signs of a strong market that you want to be putting new money into. Be lightening up on some positions in here, and if we start to roll over, it could get a little bit uglier than what we're expecting. So thanks again. Next week we'll look at the sectors and keep an eye on that 20,777 on the Dow. That's the intraday trade that would cause us to stretch out our neutral thing, and if it keeps going, and we could stretch that neutral reading out for several weeks. So at this point, keep it neutral and have a good week.